And he's no stranger to IT conversations. Sandip Agarwal, fund manager at Sowilo Investment Managers, is with us. Of course, Sandip looks at a whole range of stocks, but he's been an IT specialist for so long that we always pick his brains to understand what's going on. Sandip, hi, great to have you back on the show. Good morning.
Hi, good morning, Sylvie. Thanks so much.
So, Sandeep, before we get started, I want our team to simply put up the Nifty IT performance. And that's why sometimes numbers hit you so hard, right? We all know this, but let's put this up. The fact is that IT stocks, if you look at Nifty IT as an aggregate symbol of the sector, IT has not made money for people across time bands. Let's see if we can get that performance chart up on the screen. You look at 1 month, you look at 3 month, I looked at 6 month, I looked at 1 year, in which the IT index is down about 1%, down about 30%. Now, let's get the graphics back up. That's today. Today, the index is higher. We should get, that's 3 months, is down about 10%. Let's get the graphics up on the screen in just a bit. But even if you're looking at longer time spans, 3 years, 5 years, the IT index is negative. In fact, I checked since COVID, this is the lowest level for the Nifty IT index since September, October of 2022. So that's the kind of value destruction that's happened over the last many years. So Sandeep, let's start right there. Yeah, that's the performance chart that I was talking about. So 1 year return, 3 year, 5 year, you're negative across time bands. If someone thought that let's believe in value investing, buy right and forget it, that whole, what all the market experts preach, that, buy good stocks and leave them. Even if you left them for 3, 4, 5 years today, you're wondering, kya hai? Paisa to bana hi nahi hai. So let's start right there. What do you think of this trend? And do you see it changing anytime soon?
No, so Surbi, you're absolutely right. So I believe that the biggest mistake is that buy and forget. I don't think a sector like IT should be looked at that way, because there is in technology, the disruption cycles are very sharp, very quick, and very tough. So I don't think in my last 25 years I have ever thought of this sector as buy and forget. In fact, I would say this is the best long-term trading sector. So what I mean by that, if you start at the beginning of the disruption cycle, and if you are a hedgy and you can short, then you make tons of money for next 24 months, 30 months. On the other side, if you are again if you are hedgy and you can buy, then if you buy at the fag end of the disruption cycle, then you make tons of money again. So the data which you are showing is 5 years. If you see the data of 7 years, 8 years, it will be totally different, because what has happened is that just before COVID and during COVID, what has happened before COVID, if you remember, there was a disruption called digital, and because of that disruption, 2-3 years prior to that were very bad, and just before COVID would hit, 6 months prior to that, all the companies have pivoted themselves towards digital, and a lot of growth has started coming in. And then COVID came and hit it very hard, and the stocks were down 60-70%. And then one COVID related growth, because everyone has to be work from home, school was work from home and everything, and coupled with that, the demand of previous 2-3 years, everything bundled up. And you made, in some stocks like Persistent, Mindtree, 3x, 5x, 10x. I used to write most bullish in the decade note every week. So I have written 12 thematic notes in a period of 6 months. Have gone up 6, 7, 10 and all. So the data which you are showing is of that period when the index has gone through the roof. It has built in next 3, 5, 7, 10 years of optimism. And then we have been hit hard by the new disruption, which is the hardware disruption this time. So if you give me 1 minute, I will explain you the whole cycle. So, in IT, what happens is that you have a hardware cycle followed by the people who commercialize the cycle, and then you have the services cycle. So, and always I have seen that in last 25 years, including myself, everyone confuses the disruption with the cycle. But trust me, cycle never changes. It is only the disruption which changes. So, in technology, what happens? You transition from one technology to another, one second to third. And hardware cycle comes once in 2 decades, and software cycles or the disruption in software comes every, let's say, 7-8 years. So we have seen 3 software or non-hardware disruptions in last 20 years, but hardware disruption was prior to that, 2002. Now again, the hardware disruption has come from 2024. So you have big beneficiaries who are in the hardware, who invested 20 years in R&D and made the product like the NVIDIA's, and the numbers are there. You can see NVIDIA has not done anything in 20 years, and after that, suddenly 4 years have been good. So in this cycle also, the
It's just
hardwares have
taken
benefited
off.
substantially. Now I think they will see deceleration at some point of time, maybe in 6 or 12 months, and I think for the hedges, it could be a very, very good sell sector for a long time. The people who can commercialize it,
Yeah.
that
So
is the Anthropic.
that's Sandeep. Yeah, no, sorry. Let me just come in over there. So I completely understand your point, and that's a great backdrop, right? That this is a hardware disruption or a hardware cycle playing out, and that happens, like you're saying, once every 20 years. And the guys who are building that hardware, they are, they get top dollar valuation, which is all the US guys or, your Nvidia and all of those people, and memory stocks, and after that, what's been happening with semiconductors and all of that. The issue is that now for our Indian audience, we are not hardware experts. We've always been about software. So the question I want to now raise, which is what we discussed a couple of months back as well, is that large cap Indian IT services companies, and you've been studying the way they're trying to transition. What did we hear at the end of the TCS AGM? We had Mr. Chandrasekharan say that over the next couple of years, TCS will have as many AI agents as they have, humans. And now people are saying this whole model of going to campuses, large hiring numbers, all that's finished. It's a thing of the past. How do you assess large cap Indian IT's AI transition? Is it on track, off track, behind the curve? What's going on?
So Surabhi, there are 2 points to the transition. One is the technology transitions, for which you need to retrain your people, and as mentioned by Nandan and Chandra both, that they are doing everything on that front, and I'm 100% confident all of them will be able to do it. It is not a rocket science. I think it is very, very simple thing. We don't need people to write LLMs, right? So as long as you don't need that just to service them or make prompts or use them, I don't think you need any. It is a very difficult thing. So I think most of the IT companies will transition to that. Second part is that how do you handle the effort? So that is what the point I was trying to make, that this is in every 20-year cycle, which everyone has seen, the 3 cycles, they were the software disruption. So where efforts pause and transition to a new technology in a much bigger way. So you have not seen any effort correction in last 20 years. This is a hardware led disruption where efforts are getting cut by 30%. Now good part and bad part. So because the efforts are getting cut, what has happened is that you are seeing negative growth and such a bad commentary across the board. Good part is that what my channel check says is 70-80% of that effort reduction is that deflation is already over. We are having another 20% which should happen in this quarter, or maybe maximum by September quarter. And then when the growth starts coming in, that is that enterprise AI which we start servicing, I think there will be good growth. Now that servicing happens with AI, with prompts, with agents, or through human, that we have to see how much will be the proportion. But I see that this is a very, very good opportunity for us, and I'm 100% confident Indian IT across the board will do phenomenally well. I'm not talking about ER&D. There still I have a different and negative view, but the traditional IT services which have been hammered so badly, I think they have a very good chance of doing excellent work. And not chance, I think it is certain, because this is the part of cycle. It can't change. Only technology changes, right? So I don't have any doubt that it will do phenomenally well from here. So IT services will do well, and you will see very good growth and demand coming. Now I will reiterate that by good growth, I don't say that 20-30% growth and all that. Please don't dream of that. We are in a lower growth for longer, but very high profitable growth journey in next 5 years. So next 5 years will be defined by lower revenue growth, but very high profit growth. That is the way I see the sector.
Very, very interesting. So next 5 years for large cap Indian IT, perhaps slightly lower growth, but high profitability. So Sandeep, are you picking any IT stocks now, the large cap, the big boys? Is this a time to buy them then?
So Surabhi, 16 months back, we went zero on IT, absolute zero in our PMS. Last 45 days since I've become positive, and the stocks are down 10-12% from that time also. But we are now, almost 7-8% weight in the sector. I intend to go much higher, and we are doing that on a daily basis. So I feel very positive about the sector. I feel that, and I see, being an analyst, I can't change my DNA, so I have done numbers. And my view is that we will see a 45-70% EPS growth cumulative in next 3 years from the sector. And if that happens, and even the multiples don't re-rate, it means a 13-14% CAGR, 13-14 to 18% EPS CAGR for next 3 years. No way these stocks can be here. So definitely that much return you will make, which is a good return for us. Now, if there is some re-rating of 10%, we make much more money. That is the way I look at it.
Very interesting. So you're saying 13 to 18% EPS CAGR is possible for large cap IT over the next couple of years, right?
Yeah.
Okay. And they have, of course, valuations on their side. So that's a very interesting take on the big boys and how they're pivoting. Now, Sandeep, let's come to the mid cap space where, as you said, there is still ER&D and different companies are doing different things. And I want your take on that and break this down and simplify it for our viewers. So you have one company, KPIT, that comes out with a profit warning, something that we're not very used to here in India, citing issues with their European clients, and not just a revenue warning. They're saying profitability will be hit. This quarter it will be down. Next quarter it will be flat. So that's one end of the spectrum. Should we get worried and extrapolate that for the whole space? What did you interpret from this shocker from KPIT?
So, Surbi, if you see last almost now 2 years, I have been warning on ER&D space every day, and I have not turned positive on ER&D still. The reason is simple that, our ER&D companies, Indian ER&D companies have benefited a lot by gaining market share from EPAM and Globant, and largely because they were having some challenge because of the crisis which is happening in that part of the world. And I think that that substantial market share gain which has happened suddenly because of challenge of competitor in a geography, that has taken that growth rate for forever. And because of that, these stocks were at 6, 7, 8, 10 peg ratio, which is impossible to sustain. I agree that ER&D will grow at 2x the IT services growth rate, but at the same time, I don't think they deserve the multiple they were. Now, my view 15 months back was that 50% correction in IT services stocks and 70-80% correction in ER&D. I think across the board 50% correction has happened. Still, I believe that ER&D should correct 20% more to make any case for investment. So I continue my negative and cautious stance on the whole ER&D space. And let's say, God forbid, if they start losing back market share when crisis settles, then you have bigger challenges ahead. So I think the growth rates and the multiple which people are assigning to ER&D companies are obscene and can't be assigned. Honestly, I feel a much more correction still from here.
So what is the core reason, Sandeep, that you're still quite negative on this ER&D space? I mean, how are they being impacted by the AI transition? Just kind of give us some more color on this. Why is ER&D still not out of the woods?
So they are impacted by AI, obviously, that is number one, which whole space is. Additionally, they will be impacted by all the users of the ER&D also. So remember that, they are not pure IT services. They are basically somewhere between IT services and engineering. They are the bridge between that. So, they get impacted. For example, they will get impacted by the auto demand, right? They will get back if tomorrow, let's say, EPAM Globant starts getting market share back, which they have lost heavily in the last 5 years. They will get impacted, if there is any kind of slowdown in any of the industries in Europe or US. So IT services doesn't have a industry headwind, right? Because AI is doing phenomenally well, and I don't see that it will pull down anytime soon. I'm talking about the AI which is offered as a service, not the hardware, right? I'm very negative on hardware, but I'm not calling it out right now. I think that after 6 months it will show up. But the commercial users like the Microsoft, the Google and Anthropic and the Grok and all of them, they will do phenomenally well for 10, 15 years. So my industry tailwind is very high for me for IT services. I don't see that tailwind in the ER&D, right? And the multiples are still high. And then on top of that, they can lose back some market share back to the original great player which were there and preferred players. So there are three big headwinds in the ER&D versus lot of tailwind for the IT services. So that is the difference.
Got that. And then there are the usual suspects, Sandeep, these mid-cap. Sorry, go on. Yeah, you're just completing your ER&D point. Go on.
So I will just say that don't hold me responsible for 1 quarter down and all that, because since I became positive, also index is down 5, 7, 10%. But I'm giving you a longer term call that in next 3 years, huge money will be made in IT services. I'm reasonably confident. And I will say that let's not confuse between disruption and cycle. Everyone is confusing cycle with disruption. That is my problem. And that is a big, big gap between, I think, what people are doing and thinking. So I have a counter to that. But ER&D, I'm cautious. I will continue. I'm sorry I cut you off on the question. Please ask that question again.
No. Absolutely, Sandeep. And this is a longer term conversation. And I put in that caveat. It's a longer conversation. It's not a 5-minute conversation on which stock to buy today. Because with you, we always, love to get the bigger perspective on what's really happening in the sector. So, Sandeep, now I was coming to the path breakers. I mean, the stocks and the companies that have always managed to defy the odds. And I mean, you know which ones I'm talking about. The same names, Persistent and Coforge. I was looking at the Nuvama view, the Nuvama, IT preview. Let's pull up those graphics as well. Nuvama is actually expecting Coforge to once again be the leader in terms of earnings and growth this quarter. They're expecting Coforge to deliver again 20% growth. So that's one stock. So tell us if, what are they doing differently and if you're convinced. And then companies like Persistent, which go out in this environment, they've announced this top dollar acquisition, big acquisition, right? What do you think of their strategy? And what do you think of some of these mid caps that have, not just now, I mean, over the last, I think, 3 years, they have been presenting best in class growth?
So, Surbi, I don't comment on companies now, but I will share my view what I had when I worked on Coforge, Persistent, and few names during COVID, and I felt that all these stocks will be 10x in 2-3 years. It happened much earlier. It was very simple that what happened because of digital disruption, the demand for execution was the time period of execution shortened quickly, and because of that, the large boys who used to get the larger deals, which were spread about 3, 5, 10 years, those deals became 3 months, 6 months, 12 months, and that you cannot wait. So there was no waiting period in those deals. So all this massive democratization of deals happened. So there were the constraints which were there earlier, that you cannot get $1 billion deal or $500 million deal unless you have this track record, that track record. All get swayed away, during COVID, because everyone wanted quick execution. So Coforge, Persistent, all of them, benefited a big way in that, and because of that, they became bigger also. And fortunately for them, what has happened, the deals have further become smaller and smaller because the cycles have become quicker and quicker. Earlier disruption was 10, 15 years. Now it has become 3-4 year period. So now all these companies will continue to do well. I don't think, they have any disadvantage versus the large player. They are actually at a more advantageous space than the large cap. On Coforge, while I don't comment on companies, but when Sudhir came, we did a complete DNA analysis of the company, the people he has got, his lifestyle, his jogging, his behavior, everything. Means I wrote a 100-pager, research for like 4-5 months. You won't believe whatever detail. I don't think anyone will have those details. We went and we said that, boss, this company will do phenomenally well. So it continues to be that example. I am little cautious that both Persistent and Coforge has done a very large size acquisition. Historically, ever no large acquisition in IT services has been successful, except for Mahindra Satyam. That was also because Satyam was at a dirt cheap price. But these acquisitions are at substantial premium. So I have little worry on that. But both the companies are led by great leaders. So I will wait and watch before giving my view. But generally, I would not prefer such large acquisitions in this space, because it is very, very risky. You don't know when the people running the show can go, or some or other disruption can happen. But let me tell you, as on standalone basis, both the companies are run by great leaders. I have huge respect for Coforge CEO. He has done an incredible job, and he's a classic example why you should buy good management.
Yeah. I can't believe you studied his jogging patterns as well, huh, Sandeep? You're saying in that 100-page
Everything.
report, lifestyle, jogging, health, all of that.
Everything. So,
That's
I have spent 4-5 months only on studying the new leader at that time, and that's the reason I was so confident that this stock has to be 10x in 3 years. It happened much earlier. That is a different thing, but that is the way you have to, and it takes a lot of energy, time, and on a small cap company to do that. Data are tough, but I wanted to work a lot on the 3-4 companies at that time, and they gave huge return. Mindtree also, by the way, Mindtree, LTI, Coforge, Persistent, Birlasoft, Gensar. I worked on these 6 of them at that time, and all were all did incredibly well.
so. Which leader's lifestyle are you studying now, currently, Sandeep, or telling your team to study?
So right now, we are
IT or
running.
non-IT? Whom are you studying today?
No, so we no more study leader, because I run a PMS and there are a lot of stuff. But I will tell you what we do now also. We study sectors in a very different way. So we run projects on the sector. So we will always do deep study on particular sector where we see next 5-10 years will be good, and we invest in those sectors. So we are more working on the sectors right now rather than on specific companies.
Okay, Sandeep, this has been a delightful conversation, but I want us to wrap this up. So if someone's missed some of it in the middle, to sum it up, I'll ask that question again. IT stocks have been big wealth destroyers of the last 1.5 years. The index is still down 30%. How do you think Indian IT is pivoting towards AI? And is this the time to be buying large cap or mid cap IT stocks? Your thoughts? Quick summary.
So very quick summary, it is a lower growth sector for longer term, but very high profitable growth. The multiples which they are trading at right now are not fair. This sector will go phenomenal return. I believe that some point of time, some analysts will come and do the numbers. And when you do the numbers, you will see significant EPS growth over next 3 years. And that is the time when this sector will re-rate. I believe we are in last leg of pen, so don't hold me for 1 quarter, but I think from next quarter onwards, things will improve dramatically. Avoid ER&D, still it is very expensive. That is all my summation of the sector.
Okay, that's very nicely summed up. Sandeep, thanks very much. Every time I speak with you, I just get so much more clarity on what's happening with the sector. That's technical, it's confusing, it's going through cycles, it's going through disruption, but you make it a lot more easier to understand. Great conversation as always. Thank you very much, and we look forward to the next one. Have a good weekend.
Thank you. Thank you. Same to you.
Thank you. Bye-bye. Okay, well, that's an